Hi, today I'd like to talk to you about your attitude to investment risk. This is something we financial advisors have to measure and discuss and agree with clients every year when we do an annual review. So let me just start off by showing you an example of one. So here's a little graph. Typical attitude to investment risk might be cautious. So if you've got a cautious attitude to risk, it might grow like that, your investments. If instead you've got what I would call medium attitude to investment risk, your investments are likely to grow like that, so they'll go up and down a bit more. If you've got a high risk attitude to investment risk, it's more likely to be like this, much more volatile, but you end up in a much higher place. So that's high, that's medium, that's low risk. That's time, that's value. Now, what's the importance of that to you? Well, the reason that's important is because most people think of the word risk and immediately they think of danger, think of loss of money. In fact, many studies have shown that the number one fear of people is the fear of their investments falling, being akin to the fear of death, which I find extraordinary. I'd have thought cliff climbing would be far more fear of risk or fear of death rather, or walking across a tightrope, over mountains. You'd think that would be more risky, but actually people fear risk of losing their money as akin to death, which I find really extraordinary. Anyway, the reason why this is important, your attitude to investment risk, is because if you look at this over time, over a longer period, assume this is say 10 years, then you're always going to get a better return, well at least 90% of the time, by having a higher attitude to investment risk rather than medium, but rather than low. But look at the difference in shapes of each of these graphs. The great advantage of low risk investment, it doesn't really go down, does it? It stays in a really steady line, but at the end of the 10 years you don't end up with much money. Whereas if you're prepared to take a bit more risk, you'd have to put up with prices going up and down more, which may frustrate you, but you'll end up with more at the end. If you take high risk, you've got to put up with a lot more what we call volatility, but you get the higher reward at the end. Now, in my experience, most clients choose the middle ground because we're hardwired like that, aren't we? If we've got three choices of high, medium or low, most people go for medium. Same with prices, but it doesn't really pay off because if you're investing for the long term, you really want to get the best returns. Now, in a typical investment portfolio we have for clients, each of these strategies, let's call them, is made up of the four main asset classes that people invest in. These are the four main asset classes: cash, shares or equities, property, and bonds. Now, everyone knows what cash is. Cash is the same as the amount of money you have in the bank account. Shares or equities, I think most people know what they are. When you invest in the shares of a company and the price can rise or fall, and they'll pay dividends. Property, what we mean by property is commercial property like offices, retail units, industrial units like warehouses. And the last but not least is bonds. And what we mean by bonds is not the type you get from a building society. We're talking about government stocks or corporate bonds. They're a lower risk investment than shares. Now, when you have a low risk portfolio, you have far more money invested in cash, property and bonds than shares because it's lower risk. The higher up the scale you go, the bigger proportion is invested in shares. So at high risk, you might have 80% or more invested in shares and the rest of these other asset classes, cash, property and bonds. Low risk, you might only have 20% invested in shares. So why is this important? Well, it's important in the long run to have most money invested in shares. But at a time like today, when we're in the middle of the coronavirus lockdown and people are nervous, the stock market's had a crash 3 months ago. It's rallied, but most commentators, most experienced commentators believe there's a further crash that's going to happen. None of us know when, but it's likely in the next couple of years. As a result, I'm recommending to most clients today to consider lowering their attitude to investment risk, which will reduce the amount in shares in the short term because we could be in line for one of these dips. We don't know for sure because there's an old saying from Warren Buffett that the market can remain irrational longer than you can remain solvent, and I think that's very true today. Now, thinking long term though, once we're past this stage, if it does happen in the next year to 2 years, what you also need to consider about when you come in to manage your risk is what investor compensation is there available? Because when you hear these stories about people losing money, it's when they've got all their eggs in one basket. So if you have all your money invested in one share, quoted on the London Stock Exchange, let's say you have all your money in BP, and there's a disaster with oil, and BP goes bust. Highly unlikely, but it could happen. Well, that means you've lost all your money, and there's no investor compensation. You put all your eggs in one basket. So our strategy is to not put all your eggs in one basket, hence the reason we have money invested in these 4 asset classes. But more important than that is that the money's spread over 12 to 15 funds. Now each fund is managed by a fund manager who selects 40 to 50 shares for you to invest in typically, which means that if you've got, say, 15 funds in a strategy, and each of those funds is managed by a different fund manager, each fund manager has investor compensation available of £85,000, like you get from a bank or building society, which means if that fund goes bust, you've got 85,000 compensation. The reason that's important to you is because if you've got 15 funds, luckily I did the maths earlier, don't ask me to work it out off the top of my head, 15 times 85,000, that comes to £2.55 million, which means if you invest up to £2.55 million with us and one of the fund managers goes bust, or all the fund managers go bust, you have investor compensation available of 2.55 million. I think that's really important to be aware of that. That's tremendous investor protection in this day and age, particularly at volatile times like today. So apart from reducing your attitude to investment risk at the moment, if you feel cautious, and I must repeat myself by saying that it's not guaranteed there's going to be a further fall, although I think most experienced people think it's highly likely. If you still like to be invested in shares, why not consider putting some of your investment into our sister company's fund, the Intelligent Wealth Fund, run by Minerva Money Management. And of course, I've got a vested interest, so I'm biased to say this, but I do know, because I manage the fund, that we do have quite a lot of money currently invested in cash and in gold. And the reason we're invested in those asset classes, particularly gold is forecast to rise quite a lot in the next few years, not guaranteed again, but it's a safe haven in times of volatility, in times of war, in times of pandemics, in times of inflation, and inflation is forecast to return. So we feel it's a good safe haven at the moment and likely to experience some capital growth. But what we're waiting for is when the markets do have another big fall, we're ready to pounce and sell our cash and gold holdings and buy lots of high quality shares at very low prices. So there's a few options for you there, how you can benefit from a good investment strategy to protect your money, still make it grow during the current coronavirus pandemic lockdown.